Good morning and welcome to my episode number 17 of Mortgage Spotlight. As I said, my goal is to do 52 episodes and give whatever the little knowledge and expertise what I have to consumers who are into the housing market and especially uh, when it comes to the mortgages. So today we are going to talk about the mortgage basics. I could have made several episodes out of it, but I'll just because I don't want to confuse you people by giving more details on this basic uh, terms terminologies because I keep getting these questions from everyone. What is term, what is amortization, what is the adjustable rate, what is variable rate. I'll try to cover as much as possible today. And if you need more information, you can always contact me or send me an email or go to my website. There's a tons of information about mortgage basics. So let's dive in and straight away get into the subject. What is amortization? Amortization period is the length of time it takes to pay off your mortgage in full. Olden days, the amortization used to be 35 years. I've even seen 40 years now. If it is insurable or insured mortgage, I say insurable and insured mortgage. I don't want to confuse you. There are so many things like uh, if you're putting less than 20% down payment, that's insured. But if your property value is less than million, and even if you put more than 20%, it could be insurable from the insurer. So don't want to confuse you, but if it's insurable and insured, your maximum amortization you can get is 25 years. And if it's conventional, like if you're putting uh, 20% down, then you can get from the bank 30 years amortization. Having said that, if you don't qualify on a traditional means, there are alternative solutions where alternative lenders, they could give you amortization up to 40 years just to get you qualified for the mortgage. That's about amortization. And what is the term? Term Mortgage term is the length of time your mortgage contract is in effect. So do not get confused with the amortization and a term. Term could be 1 year, term could be 2 years, term could be 3 years. And I've not done many 10-year terms mortgages. I think we generally traditionally do about 5 years term. And if I do private or B side alternative lending, we go up to 1 or 2 years of term. But generally, if you qualify through the banks and on a side, your term is people choose a 5 year cycle. And after the term, you're free to leave that particular lender and move somewhere else for the better rate, better terms and conditions. Could be anything, right? And what is fixed rate mortgage? The term fixed rate, I keep getting this question, whether is the fixed rate is better or variable rate is better. But before I answer that question, let me tell you guys what is fixed rate. The term fixed rate mortgage refer to a home loan that is a fixed interest rate for the entire term of the loan. For example, if you took a 5 years term, and if your rate is the current rate, I know rates keep changing. I'm not into a rate market. I'm providing the best solution, and of course, and we shop for the best rate. For example, the current 5 years fixed rate is 3.8%, and if you get that 5 years fixed rate of 3.8%, it will not change till the term. If your term is 5 years, till 5 years, the 3.8% remains constant. A fixed rate mortgage is a popular product to the consumers who want to know how much they pay every month. It will help you to do your monthly budget. All right. So if you are into that space where you don't want market going up, where rates going up and down, and you want to have that fixed budget per month, that's the way to go. Okay. What is a variable rate? A variable rate home loan is a home loan with the interest rate that may change over time. It goes with the prime lending rate. Okay. If you choose a variable rate, you may be able to take advantage of any interest rate decreases over your loan term. If your rate decreases, it means you pay less interest on that home and pay more to the principal. There are advantages, there are disadvantages. If you go with the 30 years history, people who stayed 30 years, I'm sorry, I'm getting confused with the 30 years history of inflation and other stuff. If you go historically data, people who stayed with the variable rate, they always gained over fixed rate. All right. And there are certain advantage of variable rates, because I think three mortgages out of five in Canada are broken inside 5 years. So if you break a fixed rate mortgage, your penalty is very, very high. Okay, there are other ways to port the mortgage and do all kind of stuff, but with the variable rate, you drive your mortgage, and even if you want to refinance tomorrow and you get another home and you want to break it, it is just 3 months interest rate penalty. Whereas in the fixed rate, there is a IRD kicks in, that's the interest rate differential. I don't want to go deep into what is IRD and other stuff. It's a very complex formula. But in layman's language, I would say your interest rate penalty is about 3 to 5 times more. It could be more than 5 times more than a variable rate. All right. So this is about a variable rate and a fixed rate, but depending on your requirement, you choose the rate which you like and what's your goal. And there's so many things, and that's where the mortgage advisor comes in the picture and advises you the right rate for your to achieve your goals. And there are there's the credit bureau, why we should check the credit. And credit will tell the lender your character, the entire holistic picture about you. It will give you each and everything, every data, possible data, your name, your aliases, your date of birth, your employment information, your all liabilities. That's the reason when you go to the lender, tell all the liabilities what you have. Don't hide from him or her or the bank, because they come to know. If you miss a small amount is fine, but try to be as transparent as possible while doing the application with your lender. uh, there are two major uh, uh, credit bureau companies in Canada. One is Equifax. Equifax is a global analytics and data company, and it operates in about 24 countries. And the second one is a TransUnion Canada. TransUnion one was founded in 1968 in the United States, and is one of the three main credit bureaus in that country, alongside Equifax and Experian. But in Canada, widely used credit bureau companies, the Equifax, but there are few lenders still use TransUnion. Their scoring system and methods are slightly different, but they serve the same purpose, to tell the history of individual, how what the borrowing pattern, the credit utilization. There are tons of information, and in case there is no harm checking your own credit score by going to Equifax Canada online. When you check your own credit score once in a while, it won't affect your credit score. But if the lender, if it makes a credit inquiry, it affects your credit score, and your score will come down. So it's a good practice to know if somebody is misusing your identity, and check your credit score. And many people don't know there is another third one, credit companies, Dun and Bradstreet, that's provides analytics and credit reporting data for businesses. And it's an American company, was founded in 1841 and operates in multiple countries around the world. So which, even I was preparing for this episode, even I did not know about this company, let me confess. And I just, by doing some research, I also came to know. Thank you for you guys, because I was preparing for this one, and it's morely used for business purposes. Down payment is another thing. And how much down payment we need to buy a house? If you're buying under 500,000 house, you as minimum as 5%. If you're a first time home buyer, and if it's a principal residence, not only first time home buyer, if it's a principal residence, if you're using down payment for a principal residence, you can use as low as 5% down payment and up to 500. And if it is more than 500,000, from 500 to $999,000, you have to pay 10%. For example, let's say you bought a house for 600 700,000. So first 500 is 5%, that is 25,000. And 500 to 700, 200,000, that's 10%, 20,000. So you need $45,000 down payment plus the closing cost to buy $700,000 home. All right. And there is another question I keep getting. It is, what is the variable rate and adjustable rate? All right, they're pretty much same. They're driven by prime, but a variable rate mortgage is one where the interest rate changes with the market, but the monthly payments are always the same. Okay, the with the variable rate. With and adjustable rate mortgage is one where the monthly payments can change when the interest rate changes. So some of the lenders, there is a common terminology we use. You want a variable of fixed rate. Some of the lenders, when you get a mortgage from some lenders, for example, if you get a variable rate from BMO, your mortgage payments won't change. But if you get the adjustable rate, I think people will, all the lenders, they call it as a variable rate. From Scotiabank, their mortgage payment will change. Well, the only advantage is, when mortgage payment doesn't change, you're paying more toward the interest, less to when there is an increase in the interest rate, you're paying more towards the interest, less towards the principal. And if in case of adjustable rate, your interest rate adjusts, and you are paying the additional amount, additional interest, but you're towards the principal, it gives the same amount. See, these are the two basic differences on a variable and adjustable rate. Mortgage is a vast subject. I can talk and talk and talk till the wee hours of today. But I'm not going to do that because I don't want to bore you guys. I just covered the basic terminologies of the mortgage. And if you have any questions, you can always contact me. And there are many things I could talk when it comes to rates, terms, and amortization, which I could not cover in this 10 minutes. But anyway, I hope I have given you basic ideas, basic knowledge on certain terms about a mortgage, the basic fundamentals of mortgage. Hope you guys like my episode. And one request, if you're watching me, I want my presence on the YouTube. Please do subscribe to my YouTube channel. Help me, support me, and also share your knowledge. If you have a better knowledge than me in terms of any stuff which I talk, we are here to learn from each other. Share your knowledge, put your comments, and if you think that it could benefit some people, please forward my video to your friends and families. Thank you. It is a rainy day today. There was a storm in the morning, but it's beautiful. We are in the summer. Enjoy your rest of the day and rest of the week, and see you sometime next week with another topic, new topic on the mortgage side. And till then, bye bye. Thank you for watching, and meet you guys soon. Stay tuned.